Good morning and welcome back to Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. We're coming to you live from Quinnipiac's G.A.M.E Forum in the heart of New York City. Joining me for this segment, we're going to be focusing on investment and being patient. It's Rich Thompson. He's a Managing Director of Research with the Asset Management Division of Fidelity. Rich, thank you very much for joining us here this morning. Fidelity is a big company, lots of people there, so tell us about your role.
Thanks, Jill. Thanks for having me.
Thank you.
And so I'm Rich Thompson. I'm a Managing Director of Research for Fidelity. That means I oversee groups of equity analysts and fund managers. It's important to remember with Fidelity that Fidelity is a privately held company. That allows us to take a longer-term view when making strategic decisions. And this helps align with the needs of our clients. You know, most of our clients are saving for the long term, things like college or retirement savings. And everything that we do with our process and philosophy as investors aligns well with those long-term needs.
All right. Well, as a Fidelity investor, thank you very much for that
Sure.
strategic guidance. But how do you define patience?
Right. So when you're thinking about mutual funds, the way patience will manifest itself is in the turnover of the fund. So my colleague, Joel Tillinghast, who has a wonderful long-term track record, he talks about what the market pays for and what the market charges you for. And what he means by that is what the market charges you for, well, those are actions that an investor can take that generally lead to underperformance over time. Things that the market charges you for are things like seeking fun and excitement, being part of the crowd, having a stock tip that makes you an interesting person at a cocktail party. But the things that the market pays you for, or the things that lead to outperformance over time, are more challenging. They're things like loneliness, enduring some pain, enduring worry, having to have courage, and also using patience.
So why does being patient matter for the overall investment profile?
Well, patience matters because if you are doing what we're asking our analysts to do is to rate stocks over the long term. So when we ask them to put a buy or a sell on a stock, they're going to do deep fundamental research and some real due diligence up front before they rate the stock. If they've completed extensive due diligence, it will allow them to have a longer-term view and prevent them from being shaken out of the stock when the stock inevitably meets some short-term turbulence. So what I like to tell the analysts is, let's focus on the long-term destination rather than the short-term path. The reason that this ties into performance is that, well, performance, of course, is the idea of why we exist as mutual funds. And there is a correlation between performance and patience, or, as I said, turnover. So I'll share with you some statistics. We looked at a large swath of mutual funds over a long period of time. We looked at the sample size included Morningstar rated funds that had over $500 million of assets. We looked at those funds over a 10-year period, and there were about 600 funds in the sample size. When you rank those funds based on turnover, you can see an interesting correlation. The funds with the highest turnover had the worst performance, and the funds with the lowest turnover had the best performance. The delta, or the difference between the two, was about 100 basis points, or about 1% per year. Now that over time really adds up to superior performance.
Okay, so to recap and to wrap up, does Fidelity practice patience?
Yes, we certainly do. So if you look at Fidelity's asset-weighted turnover, our turnover compares very favorably to the industry. We're at the lower end of turnover. And I'm pleased to tell you that Fidelity's performance on a 1-, 3-, and 5-year basis, we've both nicely outperformed our peers, and we're outperforming our benchmarks. So it reminds me of another colleague at Fidelity, Will Danoff, who also has an extraordinary long-term track record. What he says is, Fidelity isn't the fast money, but we're the slow, smart money.
Okay, well, thank you very much for joining us at G.A.M.E today.
Thank you, Jim.
And thank you for joining me throughout the day. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.